So today we are going to start with the second chapter of accounting and finance book. The second chapter of this book talks about the bonds, what are different type of bonds, the characteristics of each bond, impact of change in interest rate on the value of bonds, and the duration of bonds. This chapter is named as calculation of YTM, where YTM stands for yield to maturity. So before we move on to the type of bonds and the characteristics of bond, let's just take a step back and look at the meaning of debt and what do we mean by the term bonds. So what is debt? Debt is basically a money which is due by one party to another. So debt can be taken in various forms. It can be in the form of bonds, bank borrowing, or fixed deposit. So in case of bonds, if these bonds are issued, suppose issued by a company to individuals, then that company is supposed to have taken debt. Companies can also take debt in a form of bank borrowing or fixed deposit. So in fixed deposit, what can happen is a company can ask individual investors to put in certain amount of money, and they promise to give certain interest on that fixed deposit. So in this case, companies said to have taken debt. Now why do companies take debt? Companies take debt so that they can run their businesses. Now every day when they are running a business, they need certain money for which they can take debt, or suppose they want to buy a machinery which cost a lot of money. In that case they can take debt. So these are some of the reasons why a company will probably take a debt. Now one of the most popular form of debt instrument is bonds. Now what are bonds? Bonds are basically the debt instruments which are issued by businesses or governments or individuals to borrow money. Now let me take an example to illustrate how bonds are issued by the companies and what are the benefits. So what happens is that suppose a company needs to buy an instrument which cost around 10,000. So what it will do is it will divide this money into 1,000 bonds of face value rupees 10 each. So suppose there are 1,000 investors who are willing to buy one bond of this company. So what they will do is they will give rupees 10 to the company per bond, and in this way the company will be able to borrow 10,000 rupees from 1,000 investors, and it will be able to purchase that machinery. So after 1 year, suppose the rate of interest is 10%. So what happens is after 1 year, if company makes profit because it has bought that machinery and it was able to produce certain goods which were profitable, so company will repay back the money. So what the company will do is it will pay back 10 rupees which was borrowed from each investor along with the interest, which is 1 rupee. So it will give 11 rupees per bond. So every investor will get rupees 11 from the company. Now this company has borrowed 10,000 rupees from the bondholders. So in case, in this case, what happens is that all the bondholders or investors who own those bonds, they have legal rights to get back the money. So in case the company defaults, and in case after a year company fails to pay rupees 11 which has been promised by it, and it fails to keep up the word, in that case what bondholders can do is they can go to the court and they can sue the company. So they have legal rights to get back that money. Now what are the advantages of issuing the bonds? Why will a company issue a bond? A company will issue bonds because the interest payments which it does on that amount tax deductible. In fact, any payments, any kind of interest payments on the debt by companies are always tax deductible. So what do we mean by the term tax deductible? What we really mean is that the interest payments are deducted from the total income to arrive at the taxable income of that company. So suppose this company earns around 1,000 rupees and it gives around 100 rupees, 100 in the form of interest payments. So the tax will be deducted only on 900 rupees and not on 1,000 rupees. So this is the main reason why we say that this interest payments are tax deductible. Now, bonds can be secured or unsecured. So what do we mean by secured bonds? So by secured bonds, we mean that a collateral has been posted for the money which has been borrowed from the market. So in this example, so suppose this company is going and it is trying to raise that 10,000 rupees. So what it will do is it will probably go and it will put its land as a collateral against this borrowing. So in this case, if a company fails to repay 11 rupees to the bondholders, what bondholders can go and do is they can go and sell this land and take out the money which they have lent to the company. So this is what we mean by when we say that bonds are secured. In case of unsecured, there is no collateral which has been posted for these bonds. Now, the bondholders are also called creditors or lenders. Now, let's go to the terms associated with bonds. So these are the terms which are commonly used whenever we are talking about bonds. Now you really need to understand these terms because these will be used throughout the chapter, and not only in this chapter, you will also come across these terms when you will be doing your JAIIB exams. Now let's go through each of these terms to understand what they really mean. So the first term which is here is face value, also known as par value. Now, what is the face value of a bond? The face value of a bond is the amount which has been promised by the bond issuer at the end of the period. So let's take an example. So suppose there's a company X which has issued a bond of for a particular price, and what it says is that after 3 years it will return 1,000 rupees to all the bondholders. So in this case, rupees 1,000 which will be given by the company X to the bondholders after 3 years is the face value or the par value of the bond. Now let's go to the next term, which is coupon rate. Now what is coupon rate? Coupon rate is the interest rate at which bond makes regular payments to the bondholders. Now suppose, taking the same example where the company X has issued a bond of rupees 1,000 to the investors. Now what it says is that it's going to make a coupon payment every year till the 3rd year at the rate of 10% interest rate. Okay, so what it means is that every year it will pay 10% of 1,000 rupees to the bondholders. So in this case, they will pay rupees 100 after every year. So not only company X will pay 1,000 rupees at the end of the year, at the end of the 3-year period, it will also make a series of payment of rupees 100 every year. So this payment of rupees 100 is called coupon payments, and the rate at which they will be giving this coupon payment, it's called coupon rate. So this is the interest rate. So in the exam, if you are ever given a question where you have to calculate a coupon payment, so all you have to do is you have to multiply coupon rate with the face value of the bond or the par value of the bond to get the coupon payment. Now what is maturity? Maturity is the term period of that bond. So suppose, so in the same example, when company X issues those bonds for 3 years, what we say is that 3 years is the maturity period for that bond. Now what is a redemption value? So redemption value is the money which bondholders get on maturity. So you can say that it is same as face value or the par value which company will pay. Now market value. So just like your shares which gets traded on share market, in the similar fashion your bonds can also get traded. You can sell your bonds to other people and they can in turn sell those bonds to others. So that is why whatever is the current market price of that bond at which you are buying or someone else is buying is called the market value of the bond. So suppose this company X bonds, after 1 year, if you want to sell it to somebody, and at that time the market price of that bond is 800 rupees, then that will be called the market value of that bond. Now let's go to the next term, which is day count convention. Now what really happens is that in case of bonds, the interest calculations are done based on various day formats. Now what are these formats? These formats are actual by actual, in which the actual number of days are counted and that is divided by the actual number of days in the period. Then there's another format which is actual by 365. So in this case they take 365 as the number of days for a year. So even if it is a leap year, they will still take 365 days. And actual is the actual number of days for which that bond has been trading or has been in the market. Then actual by 360. In this case we consider a year to be of only 360 days. This is done for the ease of calculation because 360 is a easily divisible number, and we take actual, which is the actual number of days for which that interest rate has to be calculated. Then the next is 30 by 360. So what we do in this case is that we assume that a month is of 30 days and the year is of 360 days. So a bond issuer can use any of these day count convention to calculate the interest accrued on that bond.